Listen carefully, because what I'm about to share with you isn't conspiracy theory. It's documented policy, and it's already been activated in multiple countries around the world. In 2013, something happened in Cyprus that sent shockwaves through the financial world. Banks froze. ATMs went dark. And when they finally reopened, account holders discovered that their deposits had been seized to bail out failing banks. Not through taxes, not through government intervention, through direct confiscation of customer deposits. They called it a bail-in. And here's what most people don't realize. That wasn't an isolated incident. It was a test run for a global protocol that's now embedded in banking regulations across the United States, Canada, the European Union, and dozens of other countries. The framework is already in place. The legal authority has been granted, and when the next financial crisis hits, your bank deposits could be converted into bank equity overnight, which is a fancy way of saying your cash becomes worthless stock in a failing institution. Now, I know what you're thinking. That sounds extreme. That sounds like fear-mongering. But let me walk you through exactly what's happening, why gold and silver are the only assets that can't be bail-in targets, and what you need to understand right now to protect everything you've worked for. Let's start with the mechanics of how this actually works, because understanding the system is the first step to protecting yourself from it. Traditional bank bailouts, the kind we saw in 2008, involved governments using taxpayer money to rescue failing financial institutions. The public was outraged, politicians faced backlash, and global financial authorities decided they needed a different approach for the next crisis. Enter the bail-in protocol. Instead of using public funds, banks would be allowed to convert customer deposits into bank shares. Your savings account becomes equity, your checking account becomes stock, and if the bank fails anyway, you're left holding worthless paper. The legal framework for this was established through something called the Dodd-Frank Act in the United States, which includes provisions for orderly liquidation authority. In Europe, it's the Bank Recovery and Resolution Directive. In Canada, it's buried in Budget Implementation Acts. Different names, same mechanism. And here's the critical part. These aren't theoretical policies waiting for approval. They're active law. The authority exists right now. All that's missing is the trigger event. Cyprus was the proof of concept. When Cypriot banks collapsed under the weight of Greek debt exposure, European authorities implemented the first modern bail-in. Accounts over €100,000 were hit with haircuts up to 60%. Overnight, people lost more than half their life savings. The global financial establishment watched closely, and they liked what they saw. It was clean, it was fast, and most importantly, it didn't require political approval or public debate. The banks simply froze accounts, did the conversion, and presented it as a fait accompli. Since then, we've seen bail-ins implemented in Italy, where 4 regional banks seized customer deposits. In Austria, where Heta Asset Resolution converted deposits into equity. In Portugal, where Banco Espírito Santo did the same. Each time the pattern is identical: financial stress, sudden freeze, forced conversion. But here's what makes this particularly dangerous right now. The conditions that trigger bail-ins aren't some distant possibility. They're developing in real time. Look at the regional banking crisis that erupted recently. Silicon Valley Bank collapsed in a matter of days. Signature Bank followed. First Republic went under. These weren't small community banks. These were major institutions with billions in deposits, and the only thing that prevented widespread bail-ins was emergency intervention by the Federal Reserve and FDIC. But that intervention came at a cost. The Fed's balance sheet exploded. The FDIC's insurance fund took massive hits. And both institutions have made it clear they can't keep doing this indefinitely. Federal Reserve officials have explicitly stated that future bank failures may require alternative resolution methods. That's bureaucratic language for bail-ins. The FDIC has published papers discussing how deposit insurance might not cover all scenarios. Translation: your deposits aren't as protected as you think. Now, let's talk about why gold and silver are fundamentally different from every other asset in this scenario. When you hold physical gold or silver, you own a tangible asset that exists outside the banking system. It's not a promise to pay. It's not a digital entry in a database. It's actual metal that you can hold in your hand. And that distinction becomes absolutely critical when bail-in protocols activate. Think about what happens in a bail-in scenario. The bank freezes your account. Your deposits are converted to equity. But what about your gold? If it's physical metal in your possession, the bank can't touch it. They can't convert it. They can't seize it. It exists completely outside their balance sheet. This is why central banks around the world are accumulating gold at the fastest pace in decades. They understand something that most retail investors haven't grasped yet. When the system comes under stress, physical assets outside the banking system become the only true safe haven. The World Gold Council reports that central banks added over 1,000 tons of gold to their reserves last year alone. That's the highest level of buying in over 50 years. These aren't unsophisticated investors making emotional decisions. These are the most informed financial institutions on the planet, with access to data and analysis that the public never sees. And they're not buying gold ETFs. They're not buying mining stocks. They're taking delivery of physical metal and storing it in their own vaults. Because they know that in a crisis, paper claims on gold are just another form of counterparty risk. China has been particularly aggressive. Official reserves show steady accumulation, but independent analysis suggests their actual holdings are far higher. They're buying through state-owned banks, through sovereign wealth funds, through back channels that don't show up in official statistics. Why? Because they're preparing for a monetary system where physical gold backing matters again. Russia has been equally strategic. After facing sanctions, they accelerated gold purchases and reduced dollar holdings. They've built up reserves that give them monetary independence from Western financial systems. And when bail-in protocols activate in Western banks, Russian gold reserves remain completely insulated. Even smaller nations are following this playbook. Poland repatriated 100 tons of gold from the Bank of England. Hungary brought home their reserves. Austria, Netherlands, Germany, all moving gold back to domestic storage. They're not doing this for fun. They're doing it because they understand the risk of leaving assets within a system that can freeze or convert them. Now, here's where this gets personal for anyone with significant retirement savings. If you have money in a traditional IRA or 401k, that wealth is sitting in the banking system right now. It's exposed to bail-in risk. It's exposed to currency devaluation. It's exposed to every systemic vulnerability that's building in the financial system. But there's a structure that lets you hold physical gold and silver inside a retirement account, maintaining the tax advantages while getting your wealth outside the banking system. It's called a gold IRA, and if you're sitting on $100,000 or more in retirement accounts, this might be the most important financial move you can make right now. I put together a comprehensive guide that explains exactly how this works, how to do it without triggering tax penalties, and what you need to know about storage and security. It's completely free, and you'll find it in the description below. If protecting your retirement from bail-in risk matters to you, that guide is worth your time. But let's get back to the bigger picture because understanding the full scope of what's happening is crucial. The bail-in protocol isn't just about individual bank failures. It's about systemic risk. And right now, systemic risk is building across multiple dimensions simultaneously. Start with commercial real estate. Office buildings are sitting empty as remote work becomes permanent. Valuations have collapsed, and banks are holding hundreds of billions in commercial real estate loans that are underwater. When those loans default, bank balance sheets take direct hits. Regional banks are particularly exposed. They hold a disproportionate share of commercial real estate debt. And unlike the big money center banks, they don't have diversified revenue streams to absorb losses, which means when commercial real estate implodes, regional banks are first in line for failure. Then there's the residential mortgage market. Adjustable rate mortgages are resetting at much higher rates. Homeowners who could afford payments at 3% are facing 7% or higher. Default rates are climbing, and banks are once again sitting on mortgage portfolios that are worth less than the loans outstanding. Add in credit card debt, which has hit record levels as consumers struggle with inflation. Add in auto loans, where default rates are spiking as people can't afford payments on vehicles they bought at inflated prices. Add in student loans, where repayment has resumed after years of forbearance. Every one of these is a stress point on bank balance sheets, and they're all hitting simultaneously. But here's the part that should really concern you: the derivatives exposure. Major banks hold trillions of dollars in derivative contracts. These are complex financial instruments that are supposed to hedge risk, but in reality, they create massive interconnected webs of counterparty exposure. When one institution fails, it triggers a cascade of derivative settlements that can bring down other institutions. In 2008, the derivatives market nearly destroyed the entire global financial system. Lehman Brothers' collapse triggered a chain reaction that required unprecedented government intervention to contain. And the derivatives market today is larger than it was in 2008. The Bank for International Settlements reports that global derivatives exposure exceeds $600 trillion. That's not a typo. 600 trillion, which is roughly 7 times global GDP. And all of it is interconnected through the banking system. When the next crisis hits and derivatives start unwinding, banks won't have time for orderly bailouts. They'll need immediate capital. And the bail-in protocol gives them legal authority to take it directly from depositors. Now let's talk about the currency dimension of this, because it's intimately connected to why gold and silver are essential right now. The dollar's role as global reserve currency has allowed the United States to run massive deficits without immediate consequences. But that privilege is eroding. Countries around the world are conducting trade in alternative currencies. They're building payment systems that bypass the dollar. They're reducing dollar reserves and increasing gold holdings. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working on alternative monetary arrangements. They're discussing gold-backed trade settlement systems. They're creating currency swap lines that don't involve dollars. They're building infrastructure for a post-dollar world. And every step they take in that direction reduces demand for dollars, which means the trillions of dollars held overseas could start flowing back to the United States, which would trigger inflation that makes recent price increases look mild by comparison. The Federal Reserve is trapped. If they raise rates to fight inflation, they crash the economy and trigger bank failures. If they lower rates to support the economy, they fuel inflation and destroy the currency. There's no good option. And both paths lead to scenarios where bail-in protocols become necessary. This is why gold has been quietly climbing to record highs. It's not retail investors driving the price. It's institutions, central banks, and sophisticated money managers who understand what's coming. They're moving wealth into the one asset that can't be printed, can't be digitally created, and can't be seized through bail-in protocols. Silver is following a similar pattern, but with even more explosive potential. Industrial demand for silver is surging as green energy and electric vehicle production ramps up. Every solar panel requires silver. Every EV requires significantly more silver than traditional vehicles, and supply is constrained. Above-ground silver inventories have been declining for years. Mining production isn't keeping pace with demand, and unlike gold, which is primarily held as a monetary asset and recycled, silver gets consumed in industrial applications. Once it's used in a solar panel or electronic component, it's effectively gone from the supply chain. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is still historically elevated. Throughout history, that ratio has averaged around 15 to 1. Right now, it's above 80 to 1, which suggests that silver is dramatically undervalued relative to gold. When the next financial crisis hits and investors flood into precious metals, silver could see percentage gains that dwarf gold's moves. We saw this in 2011, when silver briefly touched $50 per ounce, and the fundamentals today are far more compelling than they were then. But here's what you need to understand about timing. Nobody can predict exactly when the next crisis will hit. What we can see is that all the conditions are in place, the stress points are building, the systemic vulnerabilities are growing, and the bail-in protocols are ready to activate. In Cyprus, depositors had no warning. The banks closed on a Friday for a bank holiday. When they reopened, the bail-in was already complete. People who had their life savings in Cypriot banks lost access to their money overnight. The same pattern played out in Greece, where capital controls were imposed suddenly. ATM withdrawal limits were set at €60 per day. Bank transfers were frozen, and people who had been wealthy on paper found themselves unable to access their own money. This is the reality of modern banking. Your deposits aren't really yours. They're unsecured loans to the bank. And when the bank needs capital, they have legal authority to convert those loans into equity. Physical gold and silver can't be converted. They can't be frozen. They can't be seized through digital protocols. They exist outside the system. And that's precisely why they're essential right now. Now, I want to address something important. Some people hear this information and think it sounds extreme. They think it sounds like doom and gloom. But this isn't about predicting the end of the world. It's about understanding how the financial system actually works and taking rational steps to protect yourself. Central banks are buying gold at record pace. Are they doom and gloom extremists? Or are they sophisticated institutions acting on information and analysis that suggests gold is essential for monetary stability? Wealthy families have held gold for generations. Are they paranoid? Or do they understand something about wealth preservation that transcends any particular economic cycle? The bail-in protocol exists in law right now. That's not speculation. That's documented fact. And it exists because financial authorities believe they'll need to use it. They're not creating legal frameworks for scenarios they think are impossible. So the question isn't whether bail-ins could happen. The question is whether you're going to take steps to protect yourself before they do. And here's the thing about gold and silver. Even if bail-ins never happen, even if the financial system muddles through somehow, precious metals still serve as insurance against currency devaluation, inflation, and monetary instability. You're not betting on disaster. You're protecting against scenarios that are well within the range of historical precedent. Every major currency in history has eventually failed. The dollar has lost over 95% of its purchasing power since the Federal Reserve was created, and the pace of currency devaluation is accelerating as governments print money to cover deficits and service debt. Gold and silver have maintained purchasing power across centuries. An ounce of gold bought a quality suit in ancient Rome. It buys a quality suit today. That's not because gold has magical properties. It's because gold can't be printed. Its supply is limited by geology and mining economics, and that scarcity gives it monetary properties that fiat currency lacks. When you hold physical gold and silver, you're holding wealth in a form that has survived every financial crisis, every currency collapse, every banking panic in human history. You're holding the ultimate form of financial insurance. And right now, with bail-in protocols active, with systemic stress building, with central banks accumulating metal at record pace, that insurance has never been more important. Let me give you some specific context about what's happening in the physical precious metals market right now, because it tells you everything you need to know about where sophisticated money is flowing. Premiums on physical gold and silver, the amount above spot price that dealers charge for actual metal, have been elevated for months. That's a sign of strong demand and tight supply. When premiums are high, it means people are willing to pay extra to get their hands on physical metal. Delivery delays have been extending. Mints are running at capacity. Refineries are backed up. This isn't normal market behavior. This is what happens when demand surges and supply struggles to keep pace. Meanwhile, gold and silver ETFs have been seeing outflows. Paper gold is being sold while physical gold is being bought. That divergence tells you that informed investors are moving from paper claims to physical possession. They're reducing counterparty risk. They're getting outside the banking system. The COMEX, the major futures exchange for precious metals, has seen its registered inventory, the metal available for delivery, decline significantly. At the same time, open interest, the number of contracts outstanding, remains elevated. That's a setup for a potential short squeeze, where buyers demand physical delivery and there isn't enough metal to satisfy all the contracts. If that squeeze happens, we could see price moves that shock the market. We're talking about potential gaps of hundreds of dollars in gold and significant multiples in silver. And once that move starts, getting physical metal becomes exponentially more difficult. This is why timing matters. Not because you need to predict the exact moment of crisis, but because you want to position yourself before the crowd realizes what's happening. Once bail-ins start, once currency crisis accelerates, once the derivatives market begins unwinding, everyone will be trying to get into gold and silver simultaneously. And at that point, premiums will explode. Availability will disappear. And you'll be competing with millions of other people who suddenly understand what you're understanding right now. The smart money is moving now. Central banks are moving now. Institutional investors are moving now. They're not waiting for confirmation. They're not waiting for the crisis to be obvious. They're positioning ahead of the crowd. And that's exactly what you should be doing. Not with money you need for daily expenses. Not with emergency funds. But with wealth that you're trying to preserve and protect over the long term. If you have significant retirement savings, if you have wealth that you've accumulated over decades of work, if you have assets that you're counting on for financial security, then getting a portion of that wealth into physical gold and silver outside the banking system, protected from bail-in protocols, is one of the most rational financial decisions you can make right now. The guide I mentioned earlier walks through exactly how to do this with retirement accounts, maintaining tax advantages while getting physical metal into your possession. It covers storage options, security considerations, and how to structure everything properly. You'll find it in the description, and I strongly encourage you to review it if you're serious about protecting your wealth. Because here's the bottom line. The bail-in protocol is live. The legal authority exists. The systemic stress is building. And the next crisis could trigger implementation faster than most people imagine possible. You can't control what central banks do. You can't control when the next financial crisis hits. You can't control whether bail-in protocols get activated, but you can control whether your wealth is positioned inside or outside the system when it happens. Gold and silver give you that control. They give you wealth that exists independently of the banking system. They give you assets that can't be frozen, converted, or seized through digital protocols. They give you the same protection that central banks are securing for themselves right now. The question is whether you're going to act on this information or whether you're going to wait and hope that somehow, despite all the evidence, despite all the historical precedent, despite all the current stress points, everything will be fine. I can't make that decision for you. But I can tell you that the people who understand the financial system at the highest levels are making their moves right now. They're not waiting. They're not hoping. They're protecting themselves with the one asset class that has survived every financial crisis in human history. The bail-in protocol is live, the clock is ticking, and your window to protect yourself is open right now. What you do with that window is up to you.